The Federal Reserve will be meeting tomorrow and on Wednesday to discuss interest rates and figure out how to handle policy in a strengthening economy that's not producing much inflation at all. Steve Liesman joins us now with more. Mr. Liesman.
Morning, Andrew. The Fed is going to be thinking hard this week about whether growth could be stronger than it thinks and whether that suggests the funds rate at 2.4% is in the right place. Fed officials likely will discount the strength of the first quarter GDP report, the 3.2% number driven partly by trade and inventories. But as those factors wear off this quarter, they could be replaced by strong consumer and business spending. So Morgan Stanley's got a bearish look at 1.1% in the second quarter. Barclays, though, upbeat with a 2.5% rate. It did bring that number down by half a point after the Friday report. Barclays saying the economy has rebounded following the volatility in financial markets late this year and the elongated federal government shutdown. That said, private consumption and business investment will need to accelerate to keep the economy in expansion. Now, I didn't get this. Of course, I was on vacation, so maybe, I don't know. But look, 71% chance of a cut in January. Wow. Strong GDP report like that, and the market, well, yields rallied, of course, and the Fed funds rate follows the yields. But you can see an escalating chance of a rate cut later this year. Some people think that's crazy, but that is what the market is. Whatever growth does, the Fed has to puzzle over why inflation remained muted. All of this argues for patience, in my opinion, from the Federal Reserve and the central bank.
Why did Barclays bring its estimate for second quarter down after a strong report in the first quarter?
Because they think the inventory and the trade thing wear off in the second quarter. But look, the other thing that was maybe a little remarked was that the underlying number, the final sales number, was 1.3. That was actually higher than a lot of people expected. So there was in that report, you take out those one-off things, and you had a weaker base, but stronger than expected. And then the consumer and business spending is supposed to pick up somewhat in the second quarter, and that could.
What did you think? Did you read the Wall Street Journal article over the weekend about the idea of the melt-up? They were even talking about Larry Fink, who was on our show about a week or two ago, talking about this idea of a melt-up. But the idea being that the melt-up is completely disconnected from fundamentals, and it's just a function of this sort of Goldilocks situation we may very well be in as a function of the Fed.
Well, you know, how stocks are going to go is somebody else's department, not mine. But
we have a couple of people here.
I've always been more bullish on the economy in terms of the expectations from December, which, I mean, I think some of the market views in December about the apocalypse was going to happen look a little silly right now. And the idea of following some of that market down, I mean, to argue that the first quarter strength or even the second quarter strength is a result of the Fed backing off on their policy in December and January is also a little silly. So I think that's important that you kept a kind of steady view on the economy, that it slowed down, but the whole expectation has not been to be incredibly weak either.